More than 2 years after the capital markets crisis began, memories of losses remain deep and raw, and the recovery is still young and fragile. There have been positive signs, but they remain mixed with less certain indicators. On the negative side, the unemployment rate and home foreclosures continue to fluctuate, and debate still wages over whether the government should have been as involved as it has been. However, increasingly it seems TARP, TALF, and other initiatives are having a positive effect. Indeed, the Dow largely has been moving in an upward direction, and both GDP growth and international trade are likewise showing improvement. Commercial real estate's own positive movement has been undeniable. Both statistical and anecdotal evidence point to increased sales and leasing activity this year, and indeed by many reports, bottled up capital is likely to become uncorked. Real Capital Analytics reports a good jumpstart to the year after a strong $134 billion in sales last year. Are there still reasons for concern? Certainly. The volume of mortgages that remain to be worked out remains significant and will be further exacerbated by banks' amend and extend practices, as Stephen Bandelik and Scott Heilman noted in a recent CPE column. Furthermore, the number of banks still expected to fail remains large, and it remains difficult to structure deals, and likely will be for at least the next several months. Even the return of the CMBS market comes with a gray side. Most of the deals taking place are of the single asset variety, rather than being varied pools of assets. But CMBS delinquencies were fluctuating noticeably less in the last few months of 2010, according to Standard & Poor's data, and the fact is, a year ago no one expected the CMBS market to return at all. With 15 players now involved in the market, there's no denying that at least there's enough to start things going. And while the commercial banks have been noticeably lacking, and certainly will be needed more for the market to return to any type of volume, there are enough involved players to at least get this recovery moving. Among them, there are some of the more stable, larger commercial banks, along with life insurance companies, CMBS conduits, and the government-sponsored enterprises, despite their own questionable future. Is it too soon for optimism? Thomas Fish doesn't think so. Speaking as part of a CPE roundtable recently, the co-head of capital markets and real estate investment banking for Jones Lang LaSalle described his outlook for 2011 as being wildly optimistic. Even longtime financier Sheikh Narasimhan expressed some cautious optimism in speaking with me for a recent CPE feature, encouraged by government involvement as well as financiers' own interest in adapting their company structures for the recovering market. Our own research shows that financiers still require borrowers to put significant equity into their deals. In fact, nearly a third of those responding to our recent mortgage bankers survey said that they expect 60% equity or more. And while that number is likely to decrease over time, if history is any indication, at least it encourages stronger deals as the recovery begins. The number of distressed assets remains high, but at least it did not reach the level of the RTC days. In other positive news, FPL Advisory Group, the executive recruitment and corporate advisory firm, finds that this year executives plan to hire more, as well as to increase both salaries and longer-term compensation. Our own less formal hiring survey found that while a large number of respondents plan to maintain their hiring levels this year, fully 38% plan to add to their personnel. All in all, after some of the worst years in U.S. economic history, commercial real estate is not only doing better than expected, it is making some very positive strides. And while there's still work to be done, such performance can only help the recovery along.